Very good. So we continue from where we left last time. We started a discussion on discounting and non-discounting techniques. And if I remember very well, we gave a difference between non-discounting and discounting techniques. And the major difference, as we discussed, is time value of money, where we said that discounting techniques take care of time value of money, the time period when the cash flows are being realized. But non-discounting techniques do not take care of time value of money. It ignores. But we know as finance analysts that time affects value of money. So we started from the first method of discounting techniques, and that is discounted payback period. And we started doing a computation to help us understand it better. So in the computation, we already did the first part of it. And in that computation, we were using an example of a question under Advanced Financial Management in the CPA course, which was a sitting of May 2014, question number 2B. So that is the sitting from where we got the paper, the question, and we started discussing it. And I'm here just opening that question and share with you very fast so that we can do the remaining part. And the most important thing, ladies and gentlemen, that we are talked about is getting to know why we are using these discounting techniques, and we are giving less preference to non-discounting ones. So I will pull down this screen so that I share that question very fast. Let me share that question so that we can do that part remaining. Now, in the question here, that is question number 2, part B, we were given two projects, project X and project Y, with initial investments and the cash flows that are projected to be realized in the next 6 years, which is the project life. Remember, the cost of capital was given at 15%. And with that, we were told and required to compute discounted payback period. And we already did for project X, which is the first project. So we are supposed to go ahead and do the same for project Y. So that's what I want us to do. So let me pull it down and share where we are doing our computation. Good. Now let's do it. Let's do it. Now, if we look at the first one, which we did, and the key points that you need to remember and pick. I told you to do project evaluation or project appraisal using discounted payback period. We need to know what is discounting, and I gave you a difference between discounting and compounding. Discounting is where you have a future cash flow, a future expected cash flow, and you want to get its present value, its value today. Now you are discounting from that future value to the current one. And if you want to get a value of a figure or a projected value for the future value when you have the current one, what you're doing is called compounding. And the difference between compounding factor and discounting factor is the N, the period. So if you look at the right side, the formula that I wrote on the right side, where I said present value is 1 plus R, close bracket, raised to negative N. That is when we are doing what we call discounting, where we are raising to power negative N. Remember, we are working backwards. We have a future value and we want to get the current value from it. We are working backwards. That's why we are raising to negative N. That is discounting. But if we are compounding to get a future value, look at the formula we wrote on the left side, where we said future value is 1 plus R raised to N. Now that one is a compounding formula. Now here, we did a solution where we were discounting the cash flows expected from project X. And you remember how we were getting the discounting factors? And I told you two ways of getting the discounting factors. You can get the discounting factor using your calculator, or in most cases in an exam room, you will be given a discounting table, and there you can see the discounting table, which I'm showing to you right now. So in an exam room, you will be shown this discounting table. And I told you how to pick the factors from the discounting table, where you are looking at the period and the discounting rate. So given the discounting rate by in the question, whether it is 10%, 15, 12, 5, 6, or any number, you just come and pinpoint where the percentage discounting rate is or the cost of capital. Then you look at the period column to see which year do you want to pick its discounting, discounting factor. So you move along the row and the column to identify the point at which you want to pick the discounting factor. I believe we are going to also do it the same as we do this part B, or the next part for project Y. So let us go ahead and do the computation the same way we've done for project X. Let's go ahead and do for project Y. Very good, very good. So now we already got our payback period, discounted payback period for project X. So we are going to do the same procedure to do the payback period for project Y. Very good. So let's go ahead and do that. Let's go ahead and do that for project Y. And if you're new in this channel, I'm CPA Samuel Otieno. And here in this channel, we do business data analytics lessons. We do advanced Excel lessons. We do practical accounting and coaching on various aspects of accounting, including accounting softwares. And most importantly, we are in the tax period, and we also wish to bring to your attention that we offer eTeams integration services. eTeams integration services. We are a third-party licensed, third-party licensed eTeams integrator by KRA. By KRA, we have a license to do that, and we can always connect you and help you be compliant by connecting to the KRA database. Then at the same time, we are also selling a point of sale system, which is hybrid. And this point of sale system, when I talk about hybrid, it supports both desktop version and it is also cloud-based at the same time. And you know that cloud-based systems are the current trend of systems where you have access to your data, efficiency guaranteed, and you can always use even your tablet, you can always using your phone, or you just pick that URL and use it on any computer, and you'll be able to access your data. And so now you can be able to see the level of efficiency that this system provides to you. And again, when you talk about hybrid, even if you do not have internet connection, your system will still work because the desktop version still works. And whenever the system detects internet connectivity, it will do synchronization. It will synchronize your data, and your data will be backed up in the cloud database. And at the same time, if your system is connected to the eTeams database, it will already remit that data which is supposed to be remitted. So if you need any of such services or more information regarding the same, do not be afraid. You can reach out so that we see how best or which product will suit your situation and help you spur your business growth. Now let's continue with what we were doing. We were doing project evaluation for project Y. So I want us to go ahead and do for project Y. I would wish to open a new page and we see project Y, project evaluation. So for project Y, we are going to do the same procedure which I talked about. And like I mentioned, the first thing is to do the first column to bring in the years. Just bring the years or the period, then you bring on board the projected cash flows expected to be realized from the same project. Remember, you are doing evaluation at the start. You've not already done these projects. So whatever cash flows that you are given or that you have, they are projected or forecasted cash flows. You expect to realize them in the future during the project life. You haven't realized them yet. So that's why I normally use the word projected or forecasted cash flows. So we write the period, and the project life was 6 years, like that. After that, you bring in the cash flows as was given in the question. And I believe I've just shown you the question, and let me just bring it on board. So as shown in the question, we are going just to pick the same cash flows the way they've been given by the examiner, and I believe you can be able to see them. Project Y, you can see the cash flows given, 37,000, which is the initial investment. Then we pick the cash flows from 30,000, 8, negative 4,000, 22,000, negative 10, and then 15,000 for project Y. We already did for project X. So we move to project Y to compute the discounted payback period. That's what I'm showing you right now. So let us go ahead and do what we're supposed to do there. So let's go ahead and now list the cash flows, and we've seen the cash flows there. And if you can be able to have access to that paper, it is AFM, we are sitting of May 2014, question number 2B under the CPA rules, Advanced Financial Management. So this is the first cash flow. If I look at my physical paper, which I have next to me right here, we are having 30,000, and you've seen the 30,000 there. For year number 2, it was 8,000. For year number 3, it is negative 4,000. For year number 4, we are having 22,000. For year number 5, negative 10,000. And then for year number 6, we are having 15,000 like that. Now, after coming up with that, the cash flows, we go ahead, and because these are future projected cash flows, we need to get their present values. We want to discount them. And like I've mentioned, and we did in the previous section when we were evaluating project X, we said that you bring on board the discounting factors, and we called it, in short, we said present value interest factor. And remember, the cost of capital was given at 15% by the examiner. So that cost of capital, it can be brought in different terms. In some instances, the examiner will call it cost of capital. In some other instances, they will call it rate of return. Yeah. So you need to really look at the language that the examiner can use. And you can see in this our case, it is called the firm's cost of capital. Sometimes it can be called required rate of return or discounting rate. And you can see from our question, we were given the firm's cost of capital is 15%. This is the rate at which we are doing the discounting. Period is 6 years. You can see that. So our N will be 6. And remember, I told you, you can always compute the discounting factor using your calculator. Using the formula 1 plus r raised to negative n. And I've told you that negative n, it is because we want to work backwards from future values projected to get the current one. That's why we are using raised to power negative n. We are working backwards. So let's go ahead and now get the discounting factors. And again, I believe you still remember that discounting rates are normally given in the discounting tables. And if you look at the table that is just showing here right now, we are picking 15%. See where 15% is? I believe you can see my cursor, that 15%. And the discounting factors we're going to pick are the ones from year period 1 to the year number 6. So you just go, and after you've identified the discounting rate or the cost of capital, you can see it is 15%. Then we look at the years. So the discounting rate for year number 1 at 15% is this 0.8696. You see that? Good. Then for year number 2, we pick 0.7561. Year number 3, we also pick the 0.6575. Year number 4, we do the same at 15%. We do the same, you get that 0.5718. For year number 5, 0.4972. For year number 6, which is the final year, it is 0.4323. So these are the discounting factors that we are looking for. But even if you do not have this discounting table, of course, you can still get it online. But if you're in an exam room and you don't have this discounting table, you should not worry, because we're using the same formula. You see the formula I've just mentioned before, it is even written in this table. 1 plus r raised to negative n. That is the present value, how to get the present value interest factor. Good. So let us now apply. Now that we have seen it, it is now easier, and I believe we are all together, because you need to see where we are getting it from. So you can either use 1 plus r raised to negative n to get the present value interest factor, or you can pick it from the discounting tables. At the same time, you can also, pick from the discounting table or compute it using your calculator. Either way still works. So the first one, like we've seen there, I have my table right here, and I can be able to see this other screen without pulling down what is showing. It was 0 point, and in fact, they're the same discounting rates that we had used before. Let me just go back and we compare. You can see that these are the discounting rates that we are picking, these ones. You can see them. Yeah, they're the same discounting rates because the discounting factors, because the rate still remains the same at 15%, the period still remains the same. So that's why we are retaining the discounting factors, because none of the components have changed. That is the period and the rate. So that is what we're going to use in the next project, like the way we started. So 0.8696, that is the discounting factor for year one. For year number two, 0.7561. For year number three, 0.6575. For year number four, it is 0.5718. For year number five, our discounting factor is 0.4972. For year number six, which is the final year, we have seen 0.4323, like that. Very good. Now, how do we move from here? Once we've listed the years, the cash flows as was given in the question, and we brought on board the discounting factors. And of course, I want to believe you now know how to pick the discounting factors, where we get them from, and also how you can compute it in case you do not have it. So our intention and our interest is to get the present value. I said that these cash flows given are projected cash flows. They are cash flows that are expected to be realized from this project in the future. Now, we want to get their current value, their present value. That's why we bring on board the discounting factor. So, how do we get the present value? It is now very easy. Just pick the projected cash flow, we multiply by the discounting factor so that we get the value at present. The value at present. So I will pick my calculator, which is just right here next to me. And you can also do the same on your end, and we compare the values or the figures. So just multiply 30,000 by 0.8696, and if I do that, I can see I'm getting 26,088, like that. Good. You do the same for year number two, 8,000 multiplied by 0.7561. I can see I'm getting 6,048.8. Then again, for year number three, do the same. Just multiply negative 4,000 by 0.6575. And if I do that on my end, from my calculator, I can see I'm having negative 2,630, like that. Do for year number four, multiply 22,000 by 0.5718. And I can see I'm getting 12,579.6. For year number five, do the same. Multiply negative 10,000 by 0.4972. And that one, you don't have to hustle a lot because we are multiplying by 10,000. That brings us negative 4,000. Negative 4,972, like that. Then lastly, multiply 15,000 by 0.4323. And I'm seeing there I have 6,484.5. Very good. Very, very good. Now, after we've done the discounting of those cash flows, the future expected cash flows from the project, we now have the present value. Now, what do we do with the present value? Now, at this point in time, we now have the figures that we want to compare and ask ourselves. Remember, we are doing discounted payback period. We've already discounted our figures, so we want to ask ourselves, with the current figures, what period will it take to recover our initial investment? And I believe you remember that each project has an initial investment. So allow me to just show you where the initial investment is, because that is what we are looking to recover. Now, if you look at the screen there, you can see Project Y has an initial investment of 37,000. So this is the amount that we want to recover, right? Now, we've already discounted these cash flows and we have their current figures. So we want to look and check at what period or in what year are we going to get back our investment before we start generating profits from this project. Because when you're doing project appraisal or project evaluation, the time period to recover your investment is very important. So the project that will recover back the initial investment will rank the best, because as an investor, your interest is get your returns, and start making profits. Recover your investments and get your profit. So the project that will do that faster, that will bring you back your money and start generating profits, that project will be the best when you're doing evaluation or appraisal of two alternatives, two or more alternatives. They can be more than two at any instance. So now with this mentality, so we want to do and start accumulating the cash flows and the figures. And we ask ourselves at the end of year number one, how much are we able to get to recover back as our investment? So we are going to do the cumulative figures of the discounted cash flows for all the years, and then we pinpoint the time at which we are going to recover what we invested, which in this case is 37,000. Very good. Now that you have seen and I've already explained, let's go and do it practically, because practical application is very important. Now, we go ahead and now do what we call accumulated. Let's do the accumulated present value. So let us accumulate this value. So for year one, of course, it remains the same, 26,088. Now, how do you do accumulated present value? How do you accumulate figures? You pick the figure from the first year, and that is the total at the end of year one, the total that you are able to recover. Remember, we are looking to recover how much? 37,000. That is our interest. Now, at the end of year one, of course, we've not already recovered our investment. 26,000 is less than 37. So we go to year two and see how much are we able to recover at the end of year number two. So to get that, add 26,088 to 6,048.8. And if I do that from my calculator, I'm seeing I'm having 32,136.8. So at the end of year number two, we are able to recover a total of 32,136.8. But our investment was how much? 37,000, right? So we are yet to recover our investment. So let's go and see how much are we getting at the end of year number three. So we come to year number three. Now, to get the accumulated figure, we add the 32,000 to negative 2,630, so that we get the accumulated figure, what we are able to recover in total at the end of year number three. And if I do that, of course, the number will reduce because this one is negative, and I'm seeing I'm getting 29,506.8 like that. Have we recovered our investment? No, we are yet to recover it. So we go to the next year. We are looking to get 37,000, but we already have 29,000. So you can see we are still far from it. So we come to year number four. How much are we going to recover in year number four? Now, in year number four, the present value of the cash flow we expect, or we have currently, because we've discounted, is 12,579.6. If we add 12,579.6, let me just do that. If we add it to what we've already recovered at the end of year three, that is 29,506.8, I'm seeing that this one will give me, let me use a different color there. This one will give me 42,086.4. Now, remember, we were to recover 37,000. At the end of year four, if we take everything at the end of year four, it will be 42,086.4. That means we shall have recovered more than what we needed to recover. Remember, our interest is to ask ourselves, at what point exactly are we going to get back what we invested? Because if you surpass the 37,000, whatever is on top is now profit. That is the level of profitability. But we just want to get the exact period to recover the 37. So what do? We do not take the whole amount in year number four, because we don't need the whole amount. What we ask ourselves is, I want just to undo this one, because it is more than what we are looking for. So what we ask ourselves is, from 29,000, how much more do we need to recover 37,000? So in that case, what we just do is to get the difference. We are looking to recover 37,000, but we've already recovered 29,506.8. So how much more do we need? How much more are we looking at? So let me just do it from my calculator here, 29,506.8. We are looking to recover 7,000 more, 7,493.2. This is what is remaining to recover our investment. So there is a formula which we used when we evaluated project X. That is the same approach I want us to use here. Now, to get the payback period after discounting, after discounting, we pick the full years where we are going to get to take all the cash flow, all the cumulated cash flows that we expect to receive. And at the end of year 3, you can see we have taken everything. But at the end of year 4, we do not need to take the whole 12,000. Or out of 12,000, we only need 7,493.2 to recover our investment in full. So we are not going to count year 4 because we are not going to take everything from that year. We are going to take just part of it, and the part of it we are going to take is just the 7,000. So that means we do not count year 4 fully. We are going to recover our investment in 3 full years plus part of year number 4 because we are not taking all the cash flows realized in year number 4. I believe you are getting the argument. So we start by saying we are going to recover back, payback period is 3 full years. 3 full years plus a portion of year number 4. Of course, the portion of year number 4 is in months. So the question is, in how many months are we going to recover the 7,493, which we are remaining with to recover? You see that argument? That is how you have to understand the payback period. So we come to get the portion or the fraction of the period we need to recover the 7,000 in year number 4. We use this approach, this formula. So I will introduce a bracket and say, just take the initial investment, the amount you are looking to recover in total, and then we get the difference from the lower limit. Lower limit. And this one should not even worry you because we already computed it. You see the 7,493.2, that is the numerator here. The initial investment, I believe you know that initial investment was 37,000. Lower limit is now the cash flows at the end of year number 3. The total that we have recovered at the end of year 3, that is the lower limit. We call it lower limit. But the total amount in year number 4 is what we call upper limit, upper limit. So we have lower limit and upper limit. Now, that forms our numerator, and of course, it is the 7,000, which we've already computed here, this one here. Then in the denominator, you just take now the upper limit, the difference between upper limit and lower limit. That is how we are going to get the fraction. But again, remember, we need the period in months. And in a year, we know a year has 12 months. So this, whatever we are going to get from this bracket, we multiply by 12 to get the period in months. So to recover our total investments, we are going to recover it in 3 years plus. So the numerator we've already computed, that is the initial investment, 37,000. Let me just write it for the sake of understanding, for someone not to get confused. Lower limit, I've just told you, is the total cash flow that we will recover at the end of year 3, and it is 29,506.8, like that. Then the upper limit is the total cash flow at the end of year 4. Of course, we are just going to take part of it. That's why we are computing a fraction. And the total at the end of year 4 is 12,579.6. You can see that is the total here. That is the total to be realized at the end of year 4, but we just need part of it. That's why we are computing the fraction. Lower limit remains the same, 29,506.8, like that. Whatever we are going to get, we multiply by 12, like that. So let us get our final figure. So we are going to recover investment in 3 years. So I'm using my calculator to get the difference. So 37,000 minus 29,506. Of course, this one we already computed, and that is the same 7,493. This one here, 493.2. So we come here, and whatever I'm getting from the numerator, I'm dividing by, I open a bracket, 12,579.6 minus 29,506.8. I close my bracket, I get my answer. And what I'm getting there is 0.44 2672 and all that. So we have to convert it. So 7493 was the numerator. Let me do this. Let me confirm the denominator. Separate 12,579.6. We might minus 29,506.8, like that. Ah, good. 16. 16. Let me see. Why am I getting 16, 16, 16? No, sorry. There is a mistake that we've done here. You see the upper limit. Oh, I rubbed the upper limit. The upper limit is the total that we are supposed to recover at the end of year 4. Add 29,506 plus 12,579.6. And I remember we got some 42,000. So let me just add it again with 506.8 plus 12,579.6 like that. 42,086.4. That is our upper limit. That is the upper limit. Not this one here. I think that is what is bringing us issues. So that is 42,086. I believe you now understand that, what that upper limit is. So if you get the difference between 42,086.4 minus 29,506.8, I'm getting 12,579. So plus, we already got the numerator 7493.2 divide by 12,579.6. This one will multiply by 12. So our payback period after discounting will be 3 years. Then we get whatever is in bracket. So that is 7493.2 divided by 12,579. Then I multiply by 12 and I'm getting 7.1479. Now, because we are looking at the period in months, I would want us to just go ahead and not use 7.1. That 0.147, that means we've moved from months to weeks to days. You can even go to hours and to seconds and all that. So let us not go to the very extreme periods. Let us just work with the years and months. So this is 3 years, 7 months, like that. 3 years, 7 months. That is the payback period. Now, if you now want to make a decision in comparing the period in which you are going to recover your investment from project X, between project X and project Y, you now have to make a decision because you are doing evaluation. You are appraising this project so that you make a decision. Project X, we got a payback period. And how much was it? We were going to recover our investment in 5 years, 2 months, right? And in Project Y, we are recovering our investment in 3 years, 7 months. So if you are going to recover your investment in 3 years for Project Y, but for Project X, you're going to recover it in 5 years, 2 months. Now, which project is better? In which project are you going to recover your investment earlier? And you can see, obviously, you will pick a project where you recover your investment earliest, or the project that will give you returns faster, right? So that means automatically you can also attest to it that Project Y now reigns supreme. Project Y is a better option compared to Project X. So there we say, we give our comment. And what is our comment saying? Our comment is saying undertake Project Y. Undertake Project Y. Very good. Because it has a shorter payback period. Payback period like that. So you've made a decision. You've done evaluation or appraisal of these projects, and you've come to a point where you are making a decision on which project to pick out of the 2 options. And I believe you now understand why we are picking Project Y and leaving Project X, because Project Y is going to give us is going to recover its initial investment earlier compared to Project X. So that is how you are required to compute and do this question that the examiner gave, and that is how to compare these 2 projects. See the 2 projects. The question was calculate for each project discounted payback period. And remember, you're going to advise, because these are 2 mutually exclusive projects, and I believe you know what mutually exclusive projects are. These are projects that are competing for the same resources and they serve the same purpose. If you choose to invest in one, you automatically have to abandon the other project. So because we've seen Project Y gives us the returns or recovers the initial investment faster than Project X, then therefore we invest in Project Y and we abandon Project X. We do not invest in it because they are alternatives. They are competing for the same resources and they serve the same purpose. That is what we mean by mutually exclusive projects. I believe you remember this discussion that we had, the types of capital budgeting projects. So, ladies and gentlemen, I would wish to stop there because we wanted just to finish that bit, and I believe you have gotten something. So, if you need any information regarding advanced financial management, regarding business data analytics, and we are already on with classes. Our students are already enrolled. And if you need to enroll for our business data analytics classes, reach out so that we can be able to onboard you and we learn together. So if you want to enroll for BDA, if you want to enroll and get more information on advanced financial management, advanced financial reporting, and besides that, I've just mentioned, if you need eTeams integration services, hybrid point of sale system, like I've explained before. If you need any guidance on taxation matters, taxation or bookkeeping matters, we are able to advise. Just reach us out on 0743 715 645. As I said, I'm CPA Samuel Otieno, and I'll be glad to listen to you and give you the guidance that you need. Very good. So kindly like, subscribe, and share so that other people can also benefit from the same content. And again, you do not miss the coming classes. Now, what we are going to cover next, we are going to cover next the next payback period, the next project evaluation technique under the discounting techniques. Let me just check. We have already covered discounted payback period. We are going to do the next one, which is the IRR. The IRR. But again, even before we do IRR, I would want us to check and see, because I know payback period is a very interesting one. You see the net present value, the net present value. We do the net present value next, so that we continue like that until we cover all of them. And we'll be doing a model of getting a question. After explaining what it means, getting a question, we discuss the question so that we see how practically you can go about solving a problem or making the investment decision using the question, which is like a case scenario. So we are going to cover next what we call net present value and see what does it mean. How do you use it to evaluate or maybe appraise projects? And we continue learning from there. Thank you so much. Have a good day. Have a good day. See you next time. Bye. Bye.